We've had a range of economic data out in South Africa. Of course, many are still saying that we're still experiencing the hangover of the World Cup. But at the end of the day, it remains to be seen whether consumer demand is going to start appreciating from these levels. Give us your general sense of where we are in the South African economy.
Well, I'm of the opinion that we saw pretty strong growth, as you know, in the first quarter of this year, which was due to base effects. So that means we are unlikely to see that growth replicated in the second quarter of this year. In other words, if you saw 4.6% GDP in Q1 and 5.7% consumer spending, household spending, we would not expect to see that replicated for the whole year or indeed even the second quarter. We'd expect that to drop down, and we're looking actually for 2.8. for this year as a total for GDP and 2.3 for consumer spending. It really just means that low base effect starts to wear out, because remember 2009 was a recession, and as we work through the year the growth rates will come off, but the level of activity should be fairly constant. So it's a difficult one to really measure, but the bottom line is you're going to see much slower growth in the second half of the year than the first, and I think that's likely to be the case internationally as well, particularly if you look at what the global PMIs are saying.
Well, Annabel, at 2.8%, your growth forecast for the year slightly below what the market's looking for, and also governments, I think they're looking for a figure of around 3%, or the Reserve Bank at least. And just given your growth forecasts and where we see inflation at the moment, do you think there is room to cut interest rates? Because at 2.8%, we're not steaming ahead.
Well, I mean, 2.8 and 3% aren't terribly different. It doesn't really make much difference. But I think the point really is that we are looking at inflation averaging about 4% in the third quarter of this year. The Reserve Bank was expecting 4.5% when they had the MPC meeting in July. So I think from that point of view, we may well see a cut at the September MPC meeting. Perhaps what's even more significant is that the fact that the Reserve Bank did not cut interest rates in July clearly resulted in very significant rand strength, as we have seen recently. Now, cutting interest rates in September is going to really aid the Reserve Bank and National Treasury in trying to inhibit this rand strength, as you can see from the reserve figures this morning.
We know Investec CEO Stephen Kossov has been quite vocal about whether we should be cutting or not in South Africa, and he does say that we need to start spurring consumer spending in South Africa. It's still a very big issue for most corporates, and it's interesting because we've been seeing a lot of these numbers being released, and a lot of companies out there still saying that consumer demand has not reached stabilization at this point in time, that we're still seeing a lot of pressure. Do you think that the Reserve Bank missed an opportunity to cut rates in the previous MPC meeting? And if they do cut rates in September, do you think it's going to be 50 basis points, or do you think we could see something aggressive such as 1%?
Well, I think they definitely missed an opportunity in July. The fact that they failed to cut interest rates when the markets were expecting an interest rate cut is the reason why we have had such significant rand strength. Our carry trade, the differential between our interest rates and those overseas, the carry trade is very strong because our interest rates are so very much high. In the United States, real interest rates are negative. If our inflation rate drops down to 4%, you're going to see our real interest rates climb even higher, which clearly is going to drive even further rand strength, and that's very costly for the Reserve Bank and National Treasury to combat through reserve accumulation. In terms of the interest rate cut itself, if we do see another cut, clearly that will lessen the real interest rate differential and take that pressure off the rand that we're experiencing. Remember that 7.20 Rand is the key resistance level on the rand. If the rand goes through, that's going to start going to 6.90, and that's really going to be detrimental for growth in the manufacturing, mining sectors. As we move towards September, I think the Reserve Bank is going to be looking for data which supports an interest rate cut. But just remember, the Reserve Bank is going to have the full gamut of the South African Quarterly Bulletin at its September MPC meeting, which the markets won't have yet, because it won't be released yet, and they will have a very good view on what the South African consumer fared in the second quarter, and particularly whether there was any stimulatory effect from the World Cup or not. So it's going to be a little bit of shooting in the dark, I think, for economists without having their quarterly bulletin, whereas the Reserve Bank actually will have it. But I think on balance, given the issues I've outlined and the weakness in the economy, I certainly think a 50 basis point cut is warranted. 1% is probably too much at a meeting.
Annabel, you mentioned those golden forex reserves, and of course we had net reserves up by about $500 million in July. Foreign exchange reserves, though, up by over $1 billion. Does it look like the Treasury or the Reserve Bank have been actively accumulating reserves in the market?
They definitely have. If you have a look at the account which you've got in front of you called the Foreign Deposits Account, that's gone up by $500 million US. And that essentially means that the Treasury has actually allowed the Reserve Bank to buy $500 million. That's a lot of money worth of hard currency for it and put it on deposit. In combination, the Reserve Bank itself has purchased also around about $500 million US. Together, that's, as you said, over $1 billion US. That's a very substantial rise in reserves for a month when the rand is so very strong. And obviously, it comes at an opportunity cost, because that money could have been spent elsewhere. Government could have spent that money in social services, social welfare, could have been spent on infrastructure. So this reserve accumulation, obviously then providing some stability to the rand, comes at a cost.
What's the balance then, obviously, between reserve accumulation and allowing the rand to be strong and building the reserves which we really need?
I think the balance will probably come in terms of trying to prevent rand volatility. I think we'll all agree that the rand has been very much less volatile in recent weeks, perhaps even since April this year. And again, they have managed to prevent it from going through 720. As soon as it goes through 720, the attraction, the magnetic pole for the rand, if you will be that 690, and then it'll try and pierce that level and continue stronger and stronger because of these massive carry trades that we've been talking about earlier. So in terms of, what the trade-off really is, obviously you want to try and limit the rand strength, but not to a degree where it becomes excessively costly. Because remember, holding money in a hard currency account, you're earning much less interest than these carry traders are earning on the rands that they are holding after having sold their hard currency, and that obviously is the reason for this carry trade.
And I'm sure it must be quite tough as well, because when you look at what's happening in terms of currency depreciation with the euro and the dollar, I'm sure the Reserve Bank, although they don't play the forex markets, they've got to take those macroeconomic factors into consideration. Do you think it's a great idea to buy dollars right now? We know a lot of people are still looking at this, and central banks are looking at the yellow metal, gold, as a safe haven, as opposed to buying the dollar and the euro and other currencies where we don't really know where they're going to land up in a few months' time.
Well, I think the point of buying hard currency for Treasury and for the Reserve Bank is to prevent the rand from strengthening. So clearly buying gold is going to have a less effective effect. But if you actually look at where the currencies are trading, certainly you are seeing that the dollar is certainly driving rand strength to a significant degree. But irrespective of that, if you look at the rand across all the currencies, you can see it is stronger against all the currencies, both since the July MPC meeting and obviously since the start of this year, even on a year-on-year basis. And it's really that rand strength which is so detrimental to South Africa's economy when it is trying to just recover from last year's recession.